Welcome back to your channel. I have another special guest with us today. Brian, go ahead and introduce yourself.
Thanks, Brad. My name is Brian Weisenberger. I am the Chief Market Strategist and Managing Director for Kensington Asset Management. Kensington is a investment manager based out of Austin, Texas. We've got a myriad of different investment offerings, mutual funds, separate accounts, as well as an ETF, which will be certainly the focus of our conversation today. I think the common thread amongst everything that we do, and you'll see it when we start talking about KHPI, our ETF, is that we're really trying to look at asset classes, investment categories, and decide, is there a way that we can approach it differently? Can we be innovative in a space, bring something different? And for us, ultimately, that typically means incorporating some level of downside protection, trying to minimize volatility, improve risk-adjusted returns. And that's kind of the ethos of our firm is, can we do it smarter? Can we do it better? And can we do it with some form of protection and volatility dampening?
Today, we're going to talk about KHPI, which is your hedge equity fund running on SPY. And can you describe, you use two different methodologies in this, call spreads and put spreads. Let's start with call spreads. Can you describe what you're doing there with call spreads?
Yeah, absolutely. This is all born out of really looking at the space in its entirety. The derivative income space has exploded. There's 160 or something offerings. There's over $150 billion. And when we looked at it, we said, what is the purpose here? Well, in most cases, in almost all cases, these offerings are some asset, an index or a security with a covered call written over it. And that's great for generating income. Obviously, it's been very successful in providing yield differentiated from the yield curve. But just writing a call against an index, I think, creates two things that we wanted to address. And one of them is addressed through that call spread, which is totally capping your upside. So when you buy an index, sell a call against that index, depending on the notional coverage, you're capping a significant amount of your upside. And so we utilize a call spread, which is just a combination of two option contracts, call options. We're going to first sell a call, which is kind of that typical covered call strategy. And then a price level above that, in our case, it's going to be 3% above that on a monthly basis. We're going to buy a call. And so we're going to uncap the potential of our exposure to the index above that bought call level. And so in our case, we're going to sell a call to generate income, buy a call to uncap the upside. And that's really the premise of the call spread as opposed to the simple call is we don't want to miss out on significant moves to the upside in the S&P 500 underlying that we're buying, which is a common occurrence in some of these. And so we think it's an effective way to both generate income through the selling of the call, but still provide for some upside participation by partnering that with a bought call at a price level above it.
And you're using put spreads for your hedge. Can you describe how they actually work?
Yeah, absolutely. And this is, I think, probably the more fundamental aspect of KHPI and why we think it's such an effective solution in this space is the number one drawback of most of these offerings, even others that are using call spreads, is there's just really very little downside protection. The only protection that most of these offerings provides is the income that they're generating by selling, a call option. But if you're using that income, then it's really not a protection against downside movement of the underlying index. And so in our case, we wanted to add a layer of protection in the form of a put spread. In this case, we're buying a put spread in order to create a constant hedge on a quarterly basis. So in our case, we're going to buy a put 5% below current market, and then we're going to sell a put 20% below current market. And so that creates an effective constant hedge of 15% from down 5 to down 20% in the S&P 500. And so if the S&P is down 5 in a quarter, we're going to be down 5, minus whatever income that we generated. But if the S&P is down 10, we're down 5. If it's down 20, we're down 5. If it's down 21, we're down 6. And so creating that 15% buffer to the downside for us accomplishes two things. One is obvious, which is it protects against NAV erosion, which is a common topic in this space, is the NAV erosion. This is helpful in that regard. It lowers volatility because of that protection. But there's an ancillary aspect of that, which is if you're using the income from these products, recognize that distribution rate is being calculated against the NAV of the fund. And so if your NAV takes a 20% drawdown, so does your income. And so we want to protect the NAV, one, for the sole purpose of protecting it, but two, for consistency of income, because most of our investors are using KHPI as a diversifier for their income portfolio. And so we want to have a healthy distribution rate, but we want to have some protection into the stability of what that's being calculated against.
One key item that you mentioned is that the put spreads are quarterly, not monthly. Can you describe that a little more? Is it written at the beginning of the quarter? Are they adjusted throughout the quarter? How does that actually work?
Yeah, absolutely. So everything that we do in KHPI is systematic in terms of the timing and the levels, which I think creates a level of certainty from an investor's perspective. They know what they can expect to get because there's not a lot of variability there. And so in the case of our call spreads, we're doing those on a monthly basis at normal expiry. So that's going to be the third Friday of every month. And in the case of the put spreads, we're also doing that on normal expiry. So that's going to be the third Friday, but on a calendar quarter basis. So that's going to be March, June, September, December. We're going to roll those quarterly hedges each quarter. And so when you think about the protection, that's a 15% buffer downside hedge on a quarterly basis. Now, obviously, this won't typically be the case, but that can amount to a 60% downside protection if you were to see 15% drawdowns on a quarterly basis. But I think the more important part is, and you hear this often about other downside protection products, buffer ETFs is a good example, where the user experience, the investor experience isn't what they expected often because of the timing. If you don't get in at the exact right time, then your experience is going to be very different. And there's some of that in our regard, but because we're resetting on a regular calendar basis, you can have a really good expectation as to what to expect, particularly if you're getting in when we're rolling our options, then the user experience is going to be exactly in line with what I've just laid out, which is that 15% downside protection, the call spread on the upside. We're very systematic in that regard because I think in most cases, investors really like the predictability of that.
One thing that we talked about was back testing and analysis of your systems. How much back testing occurred before you brought this product to market?
Yeah, so a lot, and in two different forms. One is it's worth pointing out that this fund is sub-advised by a group out of Atlanta, Georgia, called Liquid Strategy. Sean Gibson and his team have been managing options-based strategies for over 25 years, so truly experts in the space. And so there's a body of knowledge that comes with that, and the testing process certainly was predicated on what he's been doing in this space for a long time. But to add to that and to ensure that we were going to be delivering the offering that we expected to the investing community, we partnered with an indexing group called Mercube. You can go to their website and they've got a number of different indexes that they have developed and tracked. And so we had them develop an index specifically for this strategy. It's called the Mercube Hedged Premium Income Index. And they, through that process, run a live index, but they also back tested it back to 2015. And so we can see that hypothetical performance for the strategy through the periods where you'd expect us to outperform, the meaningful drawdowns in the market, volatility in the market. The other thing that it allowed us to do is get a sense of the consistency of income that we could expect to generate from the premiums of the call spreads and the put spreads, that net premium income that we could generate. On KHPI, we've got a targeted and managed 9% distribution. And that's paid on a monthly basis, so 75 basis points a month. The reason that we felt comfortable setting that number at 9% was a byproduct of one, actual results within the fund, as well as a separate account that we've been managing for a little bit longer, but also relying on the back-tested data from Mercube to see what level of income could we consistently feel comfortable in distributing, looking at all the different market environments going back over time. And it has been very consistent in terms of the income that we can generate. And so that's why we're able to set it at 9%. There's an interesting byproduct of using both call spreads and put spreads, which is that their values increase and decrease in opposite directions. When volatility spikes, our call spreads become more valuable, as is the case with all of these options, because the premium you're generating is higher when you sell a call when volatility is elevated. Our put spreads become more expensive, as you would expect. But the opposite is true also. When volatility depresses and we get less premium from our call spreads, our put spreads become less expensive. And so there's a balancing order between these two that allows for maybe a little bit more consistency in terms of the income that we're generating from net premiums than someone that's maybe just on one side of that equation.
Tax efficiency. Do you use 1256 contracts?
We do. Yep. So 1256 contracts in it. Our underlying on the index is also the VU. So we get qualified dividends from the VU. And so when you look at our taxation, not unlike a lot of others in the space, not everyone, some people do it a little differently, but in our case, with 1256 contracts with qualified dividends, we would expect, and we don't have a full year from last year to look at from a tax return perspective, but we expect that the majority, 90+%, maybe significantly higher than that, is going to be in the form of a return of capital, which I know your listeners are familiar with. It can be a scary term to hear, but in reality, from a tax perspective, that means it's going to reduce your cost basis. If you hold that investment for at least a year, then that's going to be taxed at long-term capital gains. And so compared to something that's generating ordinary income on a tax equivalency basis, that can make quite a difference.
I'm just going to have to throw this out just for conversations. If I compare you to something like JEPI, how have you compared against them over the since you were in inception?
Yeah, so we're hitting our 1-year anniversary. We've just hit it, so very proud to have hit that, and it gives us a good sense of the performance over that time. Thankfully, and we're certainly proud of it. We've been able to outpace JEPI over that time since inception, and year to date, we do have a slightly higher distribution rate. And I think, again, when you think about tax equivalency in terms of the taxation of distributions, that's an interesting one to compare to. So, what's interesting about KHPI compared to JEPI or the NEOS offerings or any of the ones that are out there in the space and had a lot of success is I don't think it's either or. The truth is, I think that KHPI is a really good complement to a lot of those other offerings for a couple of reasons. One is we've talked about the downside hedge really does differentiate in terms of correlation to the market. And so it can be a really good diversifier against some of those others. But the other thing that maybe we haven't really touched on yet is which part of the appreciation curve of the underlying index are we participating in? So I mentioned that we're selling a call spread. That means we're giving up the first part of appreciation in terms of the S&P 500 movement on a monthly basis. Most other offerings are participating in the very first part of appreciation on a monthly basis and capping it above that. We're taking the opposite script. We're going to give up that first part and participate above that. And so when you combine us with a lot of these other offerings, they tend to be really complementary because then you're getting exposure to every part of the asset movement of the underlying. Whereas if it were just in one or the other, you're giving up some part of it. So I think that we can be really good complements in that regard.
That's an interesting conversation because I bring this up as fishing with fishing poles, that you want more than one fishing pole in the pond to be fishing, because you never know what fish is going to bite what pole.
I 100% agree. And, I'm sure my distribution team would kick me for saying it, but KHPI is not the only one that I own either. I see benefit in a lot of different of these offerings. We're all doing things, I think, a little differently and with different benefits, different risks. And so, yeah, I totally agree, Brad. Like all concepts in investing, you don't want to put everything in one bucket. There's power and diversification even within the same category of investment sometimes.
Well, awesome. Well, thank you for your time today, Brian. That was a really good, interesting conversation with you today. Is there anything that you want to follow up with?
No, really appreciate you having it on. I've had a chance to follow you, Brad. Congratulations on your success and growth. Look forward to doing it again.
Awesome. You're welcome anytime, Brian. Until next time, everybody. God bless.